You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, we're going to do something a little different this week. I'm going to combine my podcast, Options Playbook Radio, with a trade that I did this week in our YouTube, on the Ally YouTube channel, under the stock play of the day. So every Tuesday at noon Eastern time, I do a fairly similar situation as to what we do here on Options Playbook Radio, where we look at a specific underlying and talk about a strategy. So it just so happened that we're doing a very short-term trade in the stock play of the day. So the market has moved against it, and I wanted to give an adjustment. Now, this is a strategy that I have done previously on Options Playbook Radio, and it's just butterflies and the adjustment on the butterfly. So on the stock play of the day, on Tuesday of this week, we went in and we had the episode title, Chasing Bears with Butterflies. And that means to me that we're going to use the S&P 500 index. We're going to do a very short-term bearish trade. This had something to do with the fact that we had a small spike up in the VIX, and when the VIX and implied volatility increases, that actually decreases the cost of a butterfly. Higher implied volatility usually means cheaper butterflies. And I've looked at this trade a lot, and this is a trade that I find it very interesting. We've talked about being long a call spread and rolling that into a butterfly as a hedge. In this situation, it's not the ideal situation. The market hasn't gone against the position enough, but it has moved enough that I can take the real market quotes and I can say this is a possible adjustment. So we are taping Options Playbook Radio. It is Wednesday, August 24th. The markets are closed. The S&P 500 index is up 12. On Tuesday, on the Ally YouTube channel, the stock play of the day, we looked at the SPX. The market at that time, that was a live show. The markets were rocking and rolling. We saw the SPX at 4127.75 0.50. That's when I took my little screenshot of the trade that we look to do. We bought one of the August 26th expiration, which is this Friday, 41.25 put, sold two of the same expiration, 41.05 put, and bought one of the 40.85 put. So 1 by 2 by 1, that's a butterfly. We're looking at about just a little bit more than 20 points below where the market was at the time. So just looking for a small down move in the S&P 500 index going into Friday. Well, today that was done on Tuesday at noon Eastern time. And right now on Wednesday with the market close, we see the S&P 500 index is up a little bit. It's at $4,140. So this trade is really trying to take advantage of how options are priced in very expensive underlying indexes, and the fact that by Friday, all the time premium out of the option contracts have to disappear, and they have to be, if they have intrinsic value, they would just only trade for the intrinsic value, or obviously they're going to trade for zero because they were not in the money and have no longer have any time value. Okay, so the market is up. The trade hasn't moved much, and that has a tendency to happen. If the market was up 25 points or maybe 30 points as opposed to 12 points right now, which was just a quarter of 1%, then you'd see a little bit bigger move. But this is the trade that I would do. So I would literally wait on this trade. I would see what would happen on the open tomorrow, and then I would consider doing it. I'm going to use the live options today to talk about the hedge that I would do on this trade. And it's a 3-day trade, right? Well, you have a half a day on Tuesday because we always tape it at noon Eastern time on the Ally YouTube channel. So you got all day Tuesday, all day Wednesday, or a half a day Tuesday, all day Wednesday, all day Thursday, all day Friday. These options inside the S&P 500 index actually close at the end of the day on Friday. That's when they stop trading. These are weekly options in the SPX. All right. So the market has moved up. So ideally, I might just stay the course and just see if we could get a downturn. But if the market were to open another, let's say 12 to 15 points tomorrow, I would adjust the trade. And you don't have all day to do it because you need some time premium to make these trades kind of work. And in this instance, if we looked at this September expiration, we're looking at with 2 days remaining. The hedge here is that we're going to sell the most expensive option contract in the butterfly. So that would be the put with the highest strike price. In our case, it's going to be the 41.25 strike put. And we're going to roll in to a credit spread. So how do we do that? We take the credit from the 41.25 and we buy the least expensive put, which is the 40.85. So we are selling to close the 41.25 option contract and buying to open the 40.85 option contract. Now, the problem with this is that you are increasing your requirements. You are adding risk to the trade. You had a 20-point wide butterfly to start with. We paid $150 for it on the show. That's $150 plus commission. That was your max risk. If you do have the market go up and it does go against you, and you roll into this trade, you're going to now create a fairly hefty requirement, mainly because we did a 20-point wide butterfly. You will be short 2 put spreads, and you will have on those short 2 put spreads, they're going to be 20 points wide. So there's a $4,000 requirement at that point in time. Now, with the market trading right now, with the SPX at 41.40, that roll is an $11 credit. So that's $1,100 to do that roll and bring in this net credit to the account. And this is the reason why I'd probably wait a little bit, because the credit is still a lot relative to what we paid for the butterfly initially. What I would look to do is, if the market continued on up, this roll or this credit would come down, because I want the market to be further away before I add this risk. So if I was thinking about doing this adjustment to my butterfly, I would wait until the net credit for the roll came down to approximately $3, maybe $3.50. Okay. That means that if I do the roll, I paid $150 for the trade. Let's say I brought in a credit of $3.50 when I did the roll, that I can still make $200 on this trade. And I want to be way far away from my short put when I do this. And that means that you are basically just saying, all right, I don't want the cheese anymore. Just let me out of the trap. The market is going up into this expiration date, and I have some risk here, but now that I've sold the 41.25, that means that where my risk starts on option expiration is below 41.05, which is my short strike. And I'd be short 2 puts at the 41.05 strike, and then I would be long 2 puts at the 40.85 strike. 20 points wide, 2 by 2. In that scenario, then I have $4,000 worth of risk on that trade, right? But I have taken a losing trade and rolled into a high probability of success trade by doing this. Now would be quite a bit out of the money put spread. Now, if I put that trade on, I'm not looking to adjust anymore. I may close it. If it came back down to my short put strikes right around the 41.05 level, I would consider just closing the trade before we even got there. I don't want to lose the maximum on that trade by just letting it run. So I'm going to manage it, but I'm not going to adjust the trade anymore. And I'm just going to hope that the market doesn't really come close to the 41.05 level, and that the options will expire worthless, and I will make a few $100s on my trade without having the market go hard against me and taking on all that risk. So let me go back and reiterate it. We started on Tuesdays. If you'd like to learn, obviously it's a free show for all. Go to the Ally YouTube channel, or you can just Google stock play of the day and type my name in, and it will pop up. And we're looking to look by the August 26th expiration, 41.25 put, sell 2 of that same expiration, 41.05 puts, and then buy 1 of the 40.85 puts, creating a 20-point wide butterfly. The market, well, it was live. The midpoint was 150. Can't ever guarantee a midpoint fill. And nothing's meant to be a recommendation, but on Tuesday, that's what we were looking at. $1.50, $150 of risk for every 1 by 2 by 1 butterfly. The market has moved up. Our adjustment is we're going to sell the most expensive options contract, the highest strike put, the 41.25 strike put, and then roll into 2 put spreads by buying the 40.85 strike put. So in that instance, we create an options requirement of $4,000 that would be in your account. We're going to bring in a net credit right now. That credit is $11. So if you do it right now, you're being a little bit premature on it, but 11 minus the 150, you're going to bring in $9.50 on that trade. So you're actually making $950 if you do the roll right now, but you just have too much risk. I want the market to be farther away in order for this, for us to do this roll. We want it to be higher, so we want it farther away than the put strike, and we're going to sacrifice some of the net credit brought in. So if I'm looking at this and I'm thinking about this as my hedge and the market has moved against me, what I want to watch very closely is the price of selling the 41.25 put with that August 26 expiration and buying the 40.85 put with that same expiration, and seeing where that net credit is. As that net credit comes down, that means the market is going up. And if it got down to around the $3.50 level, I would consider doing that roll. All right, there was a lot there, but do check out Stock Play of the Day on the Ally YouTube channel. And that's going to be it for this episode of Options Playbook Radio. My name is Brian Overby, Senior Options Analyst at Ally Invest. If you have any questions you'd like us to try to address on the show, please send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. See you same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.